A retiree walks into his bank on a Monday morning. He withdraws $9,000 in cash. He is buying a used car from a private seller. The seller asks for cash. The retiree has the money. It is his money. He earned it. He saved it. He paid taxes on it. He goes home. The seller needs another day to get the title ready. On Tuesday morning, the retiree returns to the bank and withdraws another $9,000. Two withdrawals, 2 days, $18,000 total. None of it illegal, none of it hidden, all of it documented. He may have just committed a federal crime. He does not know it yet. His bank does. The bank is required to know it. The bank is required to report it. The crime is not about where the money came from. The crime is not about what he planned to do with it. The crime is the shape of the withdrawals. Two sums, each kept just under a specific number. A pattern. A federal case. This is not a hypothetical. This is the direct consequence of a law passed more than 50 years ago. A law most seniors have never heard of. A law that can turn an ordinary retiree managing his own savings into a target of a federal investigation. The number is $10,000. The law is the Bank Secrecy Act. The trap is called structuring. And once you are inside it, the fact that your money is clean does not matter. The Bank Secrecy Act was signed into law in 1970. The purpose was straightforward. The government wanted to track large cash movements. Cash is hard to trace. Cash can hide criminal enterprise. So Congress drew a line. Any cash transaction over $10,000 in a single business day, deposit, withdrawal, transfer, exchange, it does not matter. The financial institution must file a currency transaction report, a CTR. The report goes to the Financial Crimes Enforcement Network, FINCEN. It includes your name, your account number, your social security number, the amount, the date. This is not a criminal accusation. It is an administrative filing, a record, a flag in a database. For 50 years, this has been the rule. Walk into a bank with $10,001 in cash. The teller files a report. It is automatic. It is mandatory. It is not optional for the bank. The bank cannot warn you. The bank cannot help you structure your transactions to avoid the report. That would itself be a crime. The $10,000 line was never a secret, but it created an unintended incentive. If a CTR is filed every time you cross the threshold, then staying under the threshold keeps you off the radar. A rational actor with something to hide would simply never cross the line. They would break a large sum into smaller sums. 9,000 here, 9,000 there. The cash moves. The reports never trigger. Congress knew this. Congress anticipated it, and Congress wrote a second law to close the loophole. The law is codified at Title 31, United States Code, Section 5324. It prohibits structuring any transaction to evade the CTR reporting requirement. Other statutes like 18 U.S.C. Section 1956 may apply, but the primary prohibition is 31 U.S.C. Section 5003-234. Structuring is a distinct federal crime. It is not money laundering. Money laundering requires an underlying criminal activity that generated the funds. Structuring does not. Structuring only requires that you arrange your transactions to avoid the $10,000 reporting threshold. The money itself can be as clean as a Social Security check. It can be an inheritance. It can be the proceeds from selling your late wife's jewelry. The source does not matter. What matters is the shape. One $20,000 deposit, legal. A CTR is filed, no crime. Two $9,000 deposits on consecutive days, potentially a felony. The difference is not the money. The difference is the behavior. And the law criminalizes the behavior. The statute uses the word knowingly. A person must knowingly structure a transaction to evade the reporting requirement. But here is where the trap tightens. Knowledge of the reporting requirement itself is not necessarily required for prosecution. Federal courts have held that the government does not need to prove the defendant knew about the CTR. The government only needs to prove the defendant knew they were structuring transactions to avoid having the bank report them. The knowledge can be inferred from the pattern itself. An elderly couple withdrawing $9,000 every week for living expenses. They are not evading anything. They do not know the $10,000 line exists. But the pattern looks identical to structuring. The algorithm does not know their intent. The algorithm only sees the numbers. And that algorithm is watching. In the decades since the Bank Secrecy Act passed, the monitoring system has transformed. The 1970s version relied on paper, CTRs filed by hand, mailed to the IRS, and reviewed by human analysts. That system was slow. It was porous. It missed most structuring attempts. The modern system is not slow. FinCEN and the IRS now deploy machine learning systems that scan millions of transactions every day. They do not look only for single deposits that exceed $10,000. That would be primitive. That would be easy to evade. The systems look for behavioral patterns across multiple days, across multiple accounts, across multiple institutions. IRS guidelines, IRM 4.26.13, outline how agents spot structuring. Banks must monitor under BSA. Banks are required to identify clusters of transactions that appear designed to avoid CTR filings. A single $9,000 deposit is not a reportable event. A series of them is, even if no single transaction ever crossed the threshold, even if the total sum would not have triggered a report if deposited at once. The algorithm sees 3 cash deposits of $7,000 each over a week. It flags the pattern. It does not ask whether the depositor is a drug dealer or a grandmother. It does not care. Your bank is legally obligated to file a suspicious activity report, a SAR. Unlike a CTR, a SAR is not a neutral record. A SAR is not a neutral record. A SAR is an allegation. It states that the bank believes their transactions may involve criminal activity. The bank does not tell you it filed a SAR. You have no right to know. You continue making your withdrawals. You continue depositing your cash. And the file grows thicker. The IRS Criminal Investigation Division reviews SARs. FinCEN cross-references them with other databases. If the pattern persists, the case is open. You are now the subject of a federal structuring investigation. You still did not know. The first time you learn about it may be when the money is already gone. The government's power in structuring cases extends beyond investigation and prosecution. It extends to seizure. Civil forfeiture allows federal agents to take assets they believe are connected to criminal activity. Structuring qualifies. The seizure can occur before any criminal charge is filed, before any court hearing, before you have an opportunity to explain. Under civil forfeiture law, the property itself is the defendant. The case is titled United States versus the money, not United States versus you. You're not the accused. Your bank account is. To get your money back, you must prove the funds were legitimate and not structured. The burden shifts. The government does not have to prove you committed a crime beyond a reasonable doubt. You have to prove your cash was innocent by a preponderance of the evidence. This is a lower standard in reverse. The government seizes first. You fight second. The fight can take years. Legal fees can exceed the seized amount. Many people settle. Many people simply surrender. The Institute for Justice, a public interest law firm that tracks civil forfeiture cases, has documented hundreds of structuring seizures involving small business owners, retirees, and individuals with no criminal history. The money seized was often accumulated over decades. Life savings, the proceeds of a home sale, an inheritance, cash that had been deposited in small amounts, not to evade the law, but because the depositor did not know the law existed. One case involved a dairy farmer who deposited his milk proceeds in cash every week. He had done it the same way for 30 years. The deposits were always under $10,000. The bank filed SARs. The IRS seized his account. He was never charged with a crime. He spent 2 years and tens of thousands of dollars in legal fees to recover his own milk money. Another case involved a retired couple who sold their RV. They received $25,000 in cash. They deposited it in 3 installments over 2 weeks because they were uncomfortable carrying that much cash at once. The bank flagged the pattern. The account was frozen. The couple had no criminal record. They had never heard of structuring. These are not anomalies. They are predictable outcomes of a system designed to detect patterns and penalize deviation from a rule that millions of Americans do not know exists. The retiree from the opening scene. He is not a fiction. He is a composite of real cases. He withdrew $9,000 on Monday and $9,000 on Tuesday. He bought his car. He drove it home. He thought nothing of the bank visit. 3 weeks later, a letter arrives from his bank. The letter does not explain anything. It simply states that his account has been restricted pending review. He calls the bank. The bank tells him to contact the IRS. He calls the IRS. The criminal investigator returns his call. The investigator asks why he withdrew the money in 2 separate transactions. He explains, the seller asked for cash. He needed a day to get the rest. The investigator asks whether he was aware of the $10,000 reporting requirement. He says no, he had never heard of it. The investigator notes his answer. The case proceeds. The retiree has now entered a legal system where his ignorance is not a defense. The evidence against him is his own bank statement. The 2 withdrawals are clearly documented. Their proximity in time is documented. The amounts are documented. The pattern is unambiguous. The only missing element is intent. But prosecutors can infer intent from the pattern. Jurors can infer intent from the pattern. Jurors can infer it. The algorithm already flagged the pattern. His money may be seized. If it is seized, he'll need a lawyer. The lawyer will cost more than the $18,000. He will face a choice: spend his remaining savings to fight a federal agency, or let the money go and hope the criminal investigation closes. This is the structuring trap. It was designed to catch drug traffickers and money launderers. It catches them sometimes. It also catches people who have done nothing wrong except handle their own cash in amounts that look suspicious to a machine. The machine has no common sense. The machine does not know you are 74 years old and paid off your mortgage in 1982. The machine does not know you keep cash because you grew up in the Depression and you trust what you can hold. The machine does not know you are helping your granddaughter with a down payment on her first apartment and you are giving her the money in increments because that is how you have always done things. The machine sees an account that made 3 cash deposits of $8,500 in a single month. The machine flags it. The bank files a report. The government asks, what is the test for whether your behavior is structuring? It depends on whether the transactions were designed to evade the reporting requirement. But design is a state of mind. Intent is invisible. What is visible is the pattern, and the pattern alone can be enough. A single cash deposit of $11,000 is fully legal and fully reported. 3 cash deposits of $4,000 each, if done to evade reporting, can be a crime. The first scenario creates a paper trail. The second scenario avoids one. The avoidance is the crime. Even if you did not know what you were avoiding, even if you were not trying to avoid anything, even if you were simply living your life, the law does not make an exception for financial naivete. The law does not make an exception for age. The Internal Revenue Manual does not instruct agents to consider whether the subject is a senior citizen living on a fixed income with no tax liability. The manual instructs agents to look at the transaction pattern and determine whether it exhibits the characteristics of structuring. Multiple cash transactions below the threshold. Transactions conducted on consecutive days or within a short period. Transactions at different branches or different tellers. Transaction just under the reporting line, the $9,000 withdrawal. the $9,500 deposit. These amounts are practically screaming at the monitoring system. They are the signature of someone who knows the rule and is skirting it. The fact that you did not know the rule is irrelevant. The numbers look intentional, the pattern looks deliberate, and in a system that judges by pattern, you will be judged accordingly. What do you do if you handle cash in amounts that might approach the threshold? The answer is not to avoid the bank. The answer is not to hide your money under the mattress. That leads to its own set of legal hazards. The answer is simpler and more straightforward than most people realize. Do not split your transactions to stay under $10,000. If you need to deposit or withdraw a large sum of cash, do it in one transaction. Let the bank file the currency transaction report. A CTR is not an accusation. It is a record. Tens of millions of CTRs are filed every year. The vast majority generate no follow-up. They are filed, stored, and never reviewed by a human being. Having a CTR filed on your account is not a black mark. It is not an admission of guilt. It is not evidence of anything except that you moved more than $10,000 in cash. The crime is not triggering the report. The crime is evading the report. Keep records. If you withdraw cash for a specific purpose, note it. If you deposit cash from a specific source, document it. Receipts, bills of sale, withdrawal slips. These are your exhibits if you are ever questioned. The government's primary weapon in structuring cases is the ambiguity of cash. Records remove ambiguity. Records create a narrative. The narrative explains the pattern. If you give cash gifts to family members, consider using checks or electronic transfers instead. These create a clear audit trail. Cash does not. If you prefer to use cash, make the transactions in amounts that do not mimic structuring. Do not give $9,000 gifts on consecutive weekends. Give the full amount at once or space the gifts months apart with different amounts. The goal is not to look like you are trying to avoid a reporting threshold. If you are questioned by a bank employee about your cash transactions, answer honestly. Do not lie. Lying to a bank in connection with a CTR or SAR is a separate federal crime. You can be prosecuted for false statements even if the underlying transactions were completely legal. The cover-up becomes worse than the non-existent crime. If you are contacted by the IRS or FinCEN about your cash transactions, do not speak to them without an attorney. You have the right to remain silent. You have the right to counsel. Use both. The investigator is not trying to clear your name. The investigator is building a case. Your explanation that you did not know the rule will not close the file. It may become evidence that you should have known the rule. The doctrine of willful blindness can apply. You do not want to learn this from an indictment. The law is fixed, your behavior is adjustable. Knowledge is the only real protection. There is a deeper truth in this hidden trap. It reveals something about how the modern financial surveillance system works. The system is designed to find criminals. But criminals do not wear signs. They do not file reports. They do not announce themselves. So the system watches everyone. It watches the drug cartel's money launderer moving millions through shell accounts. And it watches the retiree withdrawing grocery money in cash every Friday. The same algorithms, the same flagging thresholds, the same reporting requirements, the same potential consequences. The system is not required to distinguish between the two before acting. The distinction comes later, if it comes at all. By the time a human being reviews your file, your account may already be frozen. Your money may already be in a government holding account. You may already be on a list. This is not a warning about government overreach. This is a description of how the system currently operates. The statutes are on the books. The monitoring systems are deployed. The seizures have occurred. The cases have been prosecuted. The retirees have been caught. You now know what most of them did not. The $10,000 line is real. The crime of structuring is real. The consequences are real. The machine is watching. The bank is required to report. The government can seize before proving. The only safe approach is to treat the threshold as a fact of financial life. not a suggestion to be navigated. Deposit your money, withdraw your money, move your money. But do not shape it. Do not time it to avoid a report.
The shape is what the law sees. The shape is what the law punishes. The retiree from the opening scene. Let us close his file. He did not know the rule. He did not intend to commit a crime. He bought his car. He drove it home.
He now faces a legal process that will cost him more than the car was worth, more than the $18,000, more than he reasonably has. He is not a criminal. He looks like one on paper.
And in the eyes of the system, that is often the same thing. The case is clear. The rules are explicit. The trap is set. You are now informed. Stay above the line. Do not split to avoid. File the report if you cross the threshold. Keep your records. Tell the truth. Know the law. The law knows you.